In the previous video, we discussed debits and credits. We discussed what does debit or credit mean. Debit means left and credit means right. I taught you two acronyms, DEAD and CLIC. DEAD stood for Debit, Expenses, Assets and Drawings. CLIC said Credit, Liabilities, Income and Capital, which meant that all asset accounts which fall under DEAD will increase with debit entries and decrease with credit entries. All liability accounts which fall under CLIC will increase with credit entries and decrease with debit entries. Owner's equity will increase with credit entries like capital and income and decrease with debit entries like expenses and drawings. Capital falls under CLIC. More capital means more equity, more money for the business. Income also falls under CLIC. More income means more equity. Now the last two are the ones that can confuse you, so by all means leave it at this stage and just remember these ones. But otherwise, drawings is a dead account. More drawings means less owner's equity, less for the owner to take home. Expenses also dead. More expenses means less owner's equity. Now we used this in the previous video to begin with the class example. In our first accounting equation exercise, we filled in the accounting equation side of it, how each transaction affects your actual accounting equation. In this video, we're going to continue with our example and identify which accounts will be debited and which accounts will be credited with each transaction. Our first transaction, the owner contributes 100,000 Rand to the business. First thing you need to do is identify which two accounts are affected with this transaction. The owner is contributing money, so the first account is bank. Where did it come from? The owner contributed it, and we call that capital. Now you say, right, where does bank fall in, dead or CLIC? It is an asset account, therefore it falls under dead. So we will debit expenses, assets and drawings if we want them to increase, and credit them if we want them to go down. The owner is contributing money to the business. We are doing the business's books. So the business is receiving money, so the bank account is increasing, so therefore we will debit the bank. Capital account is owner's equity. CLIC says credit, liabilities, income and capital, so therefore to increase capital you will credit the capital account and debit it to decrease. We are increasing the capital, therefore we credit capital. We've debited the bank and credited the capital. For every debit we need a credit according to the double entry system. Let's go and fill this in on my accounting equation table. The account that I've debited is bank. The account that I've credited is capital. Our second transaction, you buy equipment for cash. So the first thing you've got to do is identify the two accounts. You're buying equipment for cash. So bank, because you're paying cash, and equipment, because that is what you're buying. Bank falls under assets. Assets are dead, so therefore we will debit the expense or the asset to increase it. We do not have more money when we pay for equipment, we have got less money, so we will credit the bank. Equipment is also an asset, so therefore also increases on the debit side. We've got more equipment, therefore we will debit the equipment account. For every debit you need a credit. We've debited equipment and credited the bank. Filling this in on the accounting equation, you have credited the bank and debited the equipment account. Our third transaction, you pay the first month's rent, 2,000 Rand. Once again you are paying, so one of the two accounts that are affected must be bank again. What are you paying for? Rent. So rent expense is the other account. Please remember not to just write rent, either rent expense or rent paid, not just rent because it could be received as well. Right, so bank, as we've seen now, falls under assets. Assets is a dead account, so we've got to debit the asset if we want it to increase. We do not have more money but less money, so therefore we will credit the bank. Rent expense can be seen as owner's equity, which increases with credit entries and decreases with debit entries. Rent will therefore decrease your owner's equity. Or you could use dead and CLIC and say rent expense is an expense account, and dead says debit expenses if you want the expense to increase. Might look contradictory, but if you look at this, more expenses, more rent expense means less owner's equity. Either way, it's a debit. You pick the one that works for you and use it right the way through. I'm going to use the top option with rent expense as an expense account where we debit the expense with 2,000 Rand in this case when we want to increase the expense account, which has a negative effect on owner's equity. Filling this in on my table, you will see that we have credited the bank account and debited the rent expense. If you look at transaction number 2 and 3, we have debited equipment, we have debited rent expense. In other words, we've debited what we've bought or debited what we've paid for. The reason being we have to credit the bank. Our fourth transaction, we buy stationery on credit for 1,000 Rand. The two accounts will be creditors this time because we haven't paid for it, we've bought it on credit, so we've got creditors, our suppliers. The other account is, what did we buy? Stationery. Creditors, if you've learned your list, you'll know, falls under liabilities. Liabilities, if you know your dead and click, falls under click, so therefore credits will increase your liability. When we buy stationery on credit, we owe 1,000 Rand more. More liabilities means credit your liabilities. Stationery is an expense account. Dead and click says debit the expense if you want it to increase. More expenses, more stationery means debit that account. For every debit, you need a credit. We've debited stationery and credited creditors. Filling this in on the accounting equation table, we have credited our creditors and debited our stationery. Once again, like in number 2 and 3, we have debited what we've bought. This time we haven't credited the bank, but we've credited creditors, but we still debited what we bought or what we paid for. Transaction number 5, you buy stock for cash, 1,500 Rand. You are buying for cash, so once again the bank account is involved, and we know already by now that bank is an asset. Stock falls in the trading inventory account. That too is an asset. We are going to debit expenses, assets and drawings if we want them to increase. We are paying money and therefore decreasing our cash. Can you see that this is the fourth transaction involving the bank account? And by the time you get to the fourth transaction, bank is getting easier. You already know it's an asset. You know it goes up on the debit and down on the credit. That is why you practice accounting. You don't watch it, you practice it so that you can learn it. And by the time you do it a third or fourth or fifth time, it becomes a lot easier. The trading inventory account also falls under assets. Debit them to increase, credit to decrease. We are buying stock, so we have got more stock, so we will debit the trading inventory account. Debit trading inventory, credit the bank. Filling in your table, let's see if you can do it. Press pause, and when you filled in the answer, you can press play again to see if you were correct. Let's see if you were correct. You credited the bank and you debit your inventory. Once again, debiting what you buy and crediting wherever the money came from. Bank if you've paid for it, or creditors if they've funded your spending temporarily